Let's start with some company results. The South African lender Absa Group has posted a marginal rise in annual profit as a boost from pre-provision growth was offset by higher credit impairments. And the top 5 private South African banks, including Absa, are among the continent's biggest and are generally known to have well-capitalized balance sheets and strictly conservative lending practices. But inflationary pressures, high interest rates, regular power blackouts, and logistical bottlenecks, they're all combining to take a toll on these banks' most sensitive retail and small business clients, leading to defaults. The lender posted headline earnings of $1.11 billion for the year ending December 31st, up 1% compared to the corresponding period a year earlier. Over in East Africa, non-deposit-taking digital lenders in Kenya are seeking more detailed guidance from the central bank on the documents that they need to unlock more than 400 applications that are awaiting review for licenses. The Digital Financial Services Association says while it does welcome the recent awarding of 19 additional licenses, clear guidance from the CBK on the details of the precise documents needed will help to speed up the process. Kenya Central Bank has received 480 applications for digital lending licenses since March 2022, but it has only cleared 51, keeping 429 others in limbo over what it terms as pending documentation. Away from the African continent, Saudi Arabia's state-owned oil giant Aramco has boosted its dividend despite net profits falling by 24.7% to $121.3 billion in 2023 on the back of lower oil prices and sales volumes. The profits haul was down compared to 2022's figure of $161.1 billion, but it still was the company's second highest on record. Shareholders can expect a dividend payout of $97.8 billion, up 30% year on year. Oil revenues made up 62% of total state revenues in 2023. The Saudi Arabian government directly holds about 82.2% of Aramco, and it relies heavily on the oil giant's generous payouts, which also include royalties and taxes to keep government operations running. And finally, investors want Zara's owner Inditex to make its full list of suppliers public so that they can better assess any supply chain risks. Inditex is a bit of an outlier among big clothing retailers because it still does not publish the details of the factories it sources its garments from. Regulators and investors want greater transparency from firms. Clothing retailers in particular are under pressure to prove there is no forced labor being used anywhere in their supply chains and that garment workers are being paid a decent living wage. Proposed sanctions for not complying could include fines of up to 5% of annual revenue.